So a lot of people have looked at this and said, look, it's only a tiny proportion of the MSCI EM index. It's symbolic, it is important, but China, in terms of dollar-denominated stocks or foreign currency-denominated stocks, is 27% of the index. At what point does China get too much?
I think it could get too much very soon, because if you calculate where it could be based on the current market capitalization, could be up to 40% of the index. Now, when you have that kind of weighting in the index, it's really a little bit too much, because you're ignoring so many other countries.
And so then is the idea as an investor to sort of be aware of that, and in as much as you're able not to benchmark versus, I mean, does this make the MSCI Emerging Markets Index less useful as a benchmark?
Oh, no, it's still useful, because you have all these ETFs that need to have a benchmark, and it's now 26% of the weighting, which is okay. I'm just saying that over time, and by the way, this is not going to happen overnight.
Right.
It's going to take a number of years. Now, the good news is that hopefully India and these other markets, Brazil, will grow so that their weighting will begin to balance out where China is, but it remains to be seen.
You said in recent days that China still remains your top pick. And if we look around, there's still the voices concerned about some kind of debt event in China, the real estate sector. You can take your pick. Do you think investors are confused when they look at the risks in China, and actually the risks are not the sort of the restrictions that China puts on as a control economy, but actually the liberalization, and calibrating that
Yes,
wrong?
That's right. I think a lot of people think that, you know, if they look at it through the eyes of a Western investor from the US or Europe, it looks pretty bad, because the leverage in many cases is very high. But by the way, not higher than the US leverage. If you look at the US economy, it's quite leveraged as well. But the difference is that it's a planned economy. The major banks are owned by the government, so they can mitigate any big problem. Now, in the meantime, there are going to be bankruptcies, there are going to be problems along the way. And the government will allow that, because they want to teach lessons to those people who have gone too far in any particular direction. But you're not going to see a big crisis. I don't see that.
They can sort of contain the pain that does arise.
Exactly, because as I said, the major banks, it's as if Citibank, Bank of America, and all these other banks in America were owned by the government. And that's the case in China. So they can mitigate and take measures to prevent bankruptcies.
You know, one of the things that we've seen in terms of the rally from emerging markets is that if you look at the monetary policy that we're seeing from various EM countries, they're going in all sorts of different directions. Some at this moment, despite the fact that we've got tightening policy from the Fed, some are also tightening, some are actually loosening. Do you think we overestimate the importance of US monetary policy on emerging markets now, and can it remain so throughout this period of tightening from the United States?
I think it's been very overestimated. And if you look at the years, 3 years before January of last year, emerging markets were underperforming, and everybody said, oh, it's because the Fed is going to raise rates and everybody's afraid. But if you look at the correlation between the Fed rate and the emerging markets index, there's no correlation. Sometimes the Fed rate goes up and the market goes up. So I think people have got to focus on different things. And by the way, it's really interesting to note, you take Brazil now, interest rates 14% for companies, going down while the Fed raises. So you're going to see these discrepancies in the different markets.
Well, and that's happening here in the U.S. as well.
Exactly.
I want to ask you about valuations as well, because we have seen, despite the Fed raising rates, that the MSCI Emerging Market Index has continued to go higher. And I have a chart here on the Bloomberg that's looking at the forward price to earnings ratio of the MSCI Emerging Markets as a ratio to the MSCI World Index. The blue line here is the average, so we're below the average over the past 5 years. Does that mean that we're seeing some attractive valuations there?
Definitely. We're roughly about 20% cheaper. If you look at PE, price to book, earnings growth, by the way, is better in the emerging markets, because emerging markets on the average are growing at 4%. Places like China and India are growing at 6-7%. So definitely the valuations are good. But you've got to be careful there, because a lot of these valuations in China now have changed in the sense that the tech companies, the internet companies, have now taken a much larger share of the market. And these companies tend to have higher PE ratios.
So they're inflating the overall number, perhaps.
Exactly. But still, even with that, it's lower overall.
Well, I wanted to ask you about tech in particular because we have seen a little bit of a trend of investors looking at the so-called FANG stocks here in the U.S., comparing them with tech in the emerging markets, and that's one of the reasons why we're seeing that flow into them. Do you think that can be sustained, and do you think that the valuations of those tech stocks specifically are still attractive?
They're still attractive because unlike what we had in 2000, these companies are really making money and their earnings are increasing. So you can justify going out better price earnings ratios. But I think many of these companies are being attractive to US investors and European investors because they're often cheaper than the same type of company in the US or in Europe.
Sure.
I was looking at a chart earlier this week as well, and it looks at emerging market stock markets. It includes Russia, China, Mexico, Greece is actually in there as well. And they are all markets where you have inverted yield curves. And if we were talking about a developed market nation, we look at that and we'd go, whoa, time to get panicked. But in this case, the stock market just appears to ignore it. What's going on there, and why should we or should we not be worried?
Well, I think it's because people are ignoring these factors and are saying, look, I'm going to escape the currency risk. I'm going to escape the interest rate risk by going into equities. Because as you know, equities always adjust to the inflation and to what's happening in the rest of the economy.
So the equity markets are seen as a relative safe haven relative to other assets.
But is that a risky attitude to have at some point?
If you look long term, of course, volatility from year to year. But if you look long term, equities were the place to be anywhere in the world, whether it be the US, emerging markets, or anywhere else.
How worried are you by what we're seeing in the oil markets now? We had an analyst on programming earlier on in the show saying this is the most bearish concern that they'd seen sentiment for 20 to 30 years. I mean, that kind of feeds into the commodities, the EM story very closely too. Are you concerned?
No, the reason why I'm not concerned is because, of course, we're not going to rush into commodity companies now, although we do hold some. But you must remember that if you look at the statistics, it looks like China is reducing imports of iron ore, reducing imports of oil. But people forget that's based on the value. The price has gone down. If you look at the volumes, they continue to go up in a steady way. Oil imports, iron ore imports, okay, 1% a year, maybe 0.5% a year, that sort of thing. But no question that these countries are increasing their consumption of commodities.
So there's a misalignment with perception as far as demand is concerned out there.
Exactly, there's a misconception, and they're looking at the value of imports, and they're not looking at the real volume.
But at the same time, it might not be a negative indicator about these emerging economies, but it might be a negative indicator for the profitability of the companies in those economies, right? Because even if you're producing more of it or importing more of it, if the cost is lower, it's going to be tougher for those companies.
Of course. If you're a miner, you may be running into problems, which they have already. A lot of that is over. But then be careful, because we were just talking to a gas distributor in China. Lower gas prices is great for them because they're distributing. They're buying gas, buying from importers, and they're distributing it to the retail consumers. So it depends on what side of the fence you're.
And are they able to hold the line in terms of retail prices then?
Raise retail prices as you go forward, because distribution is getting better, so they can reach a larger audience and raise prices, generally speaking.
You're having these conversations all over the emerging markets. Where do you think the greatest misalignment is if we keep China out of it in terms of perception of what's going on in terms of the economy, in terms of the politics, in terms of the reform progress that we're seeing?
I think there's a big misperception about Africa.
Right.
Because countries in Africa are growing at a very fast pace, admittedly from a low base. And a lot of people think about African countries as really being unstable, etc. But the reality is that there are a lot of stable African countries, and there's lots of opportunities in these countries because they're just at the takeoff stage. They're just taking off.
2-3 years ago, we were in Davos. There was all this excitement about particularly countries like Nigeria. And I think there's also a perception that this is an oil producer, and therefore, given what we've seen in the oil price, it's, you know, they must be in dire straits at this moment, but the economy is far broader than that. And actually, the stock market is far broader.
Exactly.
What's your favorite economy then in Africa?
In Africa, I would have to say both South Africa and Nigeria, despite all the political
Even with the politics?
And so forth. Yeah.
Wow.
Because the consumer markets are
Right.
doing very well.
I have to sneak in a quick last question about Argentina, because we talked about China's inclusion in MSCI. Argentina, though, was left out. There has been enormous investor enthusiasm for Argentina. Does this do anything to put even a small dent in that?
It does, in the sense that, you know, the MSCI and other index providers are looking at Argentina and thinking of putting them in their indices. But you got to be careful here, because right now, they're a big fish in a small pond in the Frontier Markets Index. They go into the Global Emerging Markets Index, they're a very small fish in a big pond. So this is can be a disadvantage. You know, a lot of people want the prestige of being in the EM index, but the reality is that it may not help them very much.
Be careful what you wish for.